I'm Joan League with League Estates, and today our guest is Paul Moffitt.
Hi, Paul Moffitt from the Moffitt team, Cross Country Mortgage.
Today we're going to be talking about mortgages, loans, and how to do creative financing to actually compete in this market with cash offers to try and buy a house.
So what I'd like to talk to you guys about today is we have what we call a quick close guarantee. We're pre-underwriting our clients in advance to make them super competitive. We can close FHA and conventional loans in as quick as 14 days, and we guarantee it with a $300 a day per diem. And also with VA and jumbo loans, we're closing in 21 days or sooner, and we back that also with a $300 a day guarantee.
Okay, so what does that mean, the $300 a day guarantee?
So in the offer, we have our realtor partners write in the special remarks that if we do not close escrow in said time, we will pay the seller $300 for every day that we're late. I can tell you that last year we only had to pay out twice. Once was because of solar, which wasn't no fault to anybody's, but I still paid, and the other one was an internal issue that we were working on insurance that took a couple extra days.
So here in Orange County, there's a lot of competition to buy a house, and there's a lot of cash buyers that we're competing with. So are there any mechanisms that you can help to compete with the cash buyer? So I know you've mentioned bridge loans before.
Yeah, so bridge loans are a valuable solution for some folks. There's a couple different types of bridge loans. There are some that help with just the down payment to the new property, and if you qualify for both, that is one way to do it. But also you can take money out of a current property and utilize those funds in purchasing your new property.
Oh, great. And so what's the advantage and disadvantage of that?
Advantage is you are then for sure competing with other cash offers like yourself, because you will have the cash to purchase that other said real estate.
Okay, and the disadvantage?
Disadvantages, the costs that are associated with bridge loans can be costly because these are considered non-QM loans. They are non-qualified mortgages. A non-qualified mortgage does not have to meet any of the traditional loan parameters, so they are able to charge you a substantially higher cost to obtain the loan. So there are pluses and minuses to everything, and that is one of the minuses to that type of a loan.
Oh, okay. Great. And so what would be an alternative to that expensive loan?
So when we do our quick close guarantee, if a seller puts their house on the market on a replacement property needed in order to close on their particular escrow, we get that client fully underwritten. We guarantee the seller that we will still close in the 14 days because the other sale transaction that our buyer is in is able to close their transaction in regards to the new purchase. So it's almost like a simultaneous close, but it allows the seller of the property that we're wanting to purchase the confidence that they're not contingent upon a sale because the sale is already happening.
Okay. And you said that when you give an approval for a loan, that it's actually underwritten. Can you explain that? What that
Sure.
means?
So there are three different types of pre-approvals. There's a pre-qualification. This pre-qualification is simply someone getting on the phone calling and saying that they've got 800 credit and they make $1 million a year. There is a pre-approval, which is a DU underwritten approval. So we gather their credit, their income, their assets. We run them through DU, which is a desktop underwriter from Fannie Mae, and we can issue a pre-approval. What we do on top of that is by putting them into an actual underwriter. The underwriter underwrites the loan on a to-be-determined property, and it allows us to go in with a conditional loan approval on a to-be-determined property. It elevates us up with cash, to be very honest.
Oh, great. So you're pretty much guaranteed that it's going to close.
Absolutely. It is how we guarantee that we will close in 14 days. Because we've already underwritten the loan. So the only things that we require after that is an executed RPA, a earnest money deposit, insurance, and a couple other little documents, and we're basically ready to close the loan.
Excellent. Okay, do you recommend for traditional mortgages or ARMs, 7, 10, 15, 30 years? What do you recommend?
So right now, depending on the size of the loan, if your loan is under 647, 200,000, the problem is Fannie Mae does not want anything to do with an adjustable mortgage. So your real option on that right now is a 30-year fixed mortgage. However, if you have the credit score and you have the assets, I have been recommending a 7-year fix to those who are comfortable. That means the loan will stay fixed for the first 7 years and then it becomes adjustable. Historically speaking, consumers do some type of real estate transaction within 3 to 6 years, right? So they're either refinancing, they're selling, they're doing something. So we look at homes as a long-term investment and interest rates as a short-term investment, with the exception of what we saw the last couple of years when interest rates were substantially lower than we'll ever see probably in our lifetime again. The rates now are back to pre-pandemic levels, so they are rising. We think they might continue to rise, and therefore a 7-year fixed solution gives them a substantially lower interest rate and cost on a monthly basis.
Okay. And what do you see happening with the interest rates in the market over the next year?
So I believe, and don't hold me to this, I believe we will see rates increasing through the year, and then sometime in the first or second quarter of next year, I think we're going to see a interest rate reduction, because I truly believe we will be in a recession and the government will have to go back into buying mortgage-backed securities, which ultimately lead to lower rates.
So that's kind of what happened in 2018. They tried to raise the rates and then brought them back down?
Correct. Yeah. So what people don't understand is that interest rates are not tied to the Fed fund rate. So when the news comes out that they're raising the Fed fund rate, everybody panics because they think that's mortgage interest rates. It has an effect on mortgage interest rates. However, as the Fed fund raises, historically we've seen prices decrease because people are getting back into mortgage-backed securities. Mortgage-backed securities is what truly drives interest rate. It is not the Fed fund rate.
Oh, interesting. So is that because mortgages are considered a safer place sometimes?
Yeah, so when we were seeing oil prices rise dramatically, people were taking their money out of mortgage-backed securities and putting it in oil.
That makes sense. Yeah.
Right? And so then when that security becomes unstable or starts to go back in a different direction, people will either invest in gold, they'll invest in mortgage-backed securities, they might go back into the stock market. So when you see a big fluctuation in the market, it's because people are constantly moving money.
Trying to maximize their profit. Yeah. So let's see here. Now, when you do take out a loan, so you put 20% down, and or less than 20% down, you have to get PMI insurance. Mm-hmm. Well, PM insurance, right?
It is PMI.
Is it PMI insurance?
Yeah.
Okay. Then I've heard that you said before that the rates were actually coming down on PMI. Can you explain that?
Yes. So private mortgage insurance companies, they issue insurance based on someone's credit score, what their loan to value is. But recently, because underwriting is so strict, their risk has dramatically reduced. For example, the other day we had a loan that was approximately $700,000, and they were putting down 10%, and their mortgage insurance was only $103. Now, 3 or 4 years ago, that would have been $200+. So the cost of mortgage insurance has dramatically gone down, especially in the private sector. And so when people tell me that they want to wait till they have 20%, I tell them often I think that's a very foolish idea, because people in 2019 who put down 5% last year had 22% equity. So the market is going to continue to go up. We are in a massive inventory problem for the foreseeable future. And so the sooner that someone can become a homeowner, it's the sooner that they can build their own wealth through real estate.
Right. So, and plus, you could take that money you save with the the lower down payment, invest it in stock market or something else.
Absolutely.
Make that
I
money
often tell people, cash is king. Keep your cash. Let the bank take the responsibility.
Right.
With mortgage insurance being so low, and eventually it's going to drop off once you reach 78% of the value of the home based on the time of the loan acquisition. So some people think that it's going to drop off in 3 to 5 years, or as soon as the market continues to rise, they can get out of private mortgage insurance. That is a false sense of information that people have put out on the airways. It does not drop off until the appraised value or purchase price, the lesser of the two, reaches 78% of that loan. That's when private mortgage insurance will actually drop off, or you have to do something like refinance and see if you have enough equity in the property to remove mortgage insurance.
So in 4 or 5 years down the road, and you want to get your house off PMI, can you get your house reappraised? And if it reappraises, with that 78%.
So you would, yeah, I understand what you're asking, and that's a question that's often asked. And the best, the best answer to that question, quite honestly, is what happened in 2008 will never happen again. And that was home prices were rising dramatically, as everyone knows, and then all the mortgage insurance was taken off of all these loans. And then when the market crashed, all of the banks were left holding the bag with no insurance. Mm-hmm. And so now the only way to remove it is through a refinance or reaching that 78% from time of acquisition.
So from the 78% of the original buying price, is that correct?
That's correct. Yeah, your loan, so you could look at an amortization schedule, you could find out when it would drop off, and then you would contact the servicer of the loan at that time and say, according to my information, I'm able to now remove my private mortgage insurance because I've reached 78% of the initial loan amount.
Okay, that was very informative. I really appreciate you coming on the show and telling us about the loans. And I know one big problem we've had with trying to get customers into houses is they have to compete with cash. And with these tools, I think that's now possible.
Yeah, we've had incredible success with our Quick Close program. I was able to help 142 families last year, and out of those, about 30% of those took advantage of our Quick Close program. We recently got 3 more families into escrow within the last couple of weeks, and they were all because of our Quick Close guarantee. The one thing I would like to point out is that a lot of cash buyers feel like they've got no skin in the game. Right. And they ask for the most amount of repairs, or they think that if they don't get what they want, they can walk away and they can start over. When we're underwriting our clients and I'm calling the listing agent on their behalf, I'm explaining to that listing agent that they love this home. They're not going to be asking for everything that needs to be, on their, inspection report taken care of. Yeah. If it's a hazard, then yes. But if it's not a hazard, we're kind of walking our clients along with our real estate partners and telling them, hey, if we get this house, you have to understand you're not going to get everything that's on the inspection report taken care of. And when you give that information to a listing agent along with the guarantee that we're going to close in time, our offer often beats out cash in some cases because the certainty of the close is still guaranteed because we've already underwritten that client and we've expressed that they're not going to ask for everything at the time of inspection.
And that's actually what we've seen too when we actually sell a house and we have a cash offer. As the competing prices go up a little bit, the cash offer is more likely to back out because they know, I don't have to be here, I can just walk away. Where the loan or a client with a loan is more invested in acquiring the property. So
absolutely,
I definitely see that on our transactions. So. Okay, so with these loan tools and with Joan's negotiation skills and her ability to streamline the offer so that We drop all the contingencies that aren't really needed. You know, we leave inspection contingency if needed, but we shorten it down to say 7 days. So we make the offer really attractive to the seller, and along with the loans that are as good as cash, you have a really good chance of getting a property. So if you want to work with us and buy a property, give us a call, 949-298-0727. Thank you. And thank you for coming on the show. I really appreciate it.
It was my pleasure. Thanks for having me. And happy house hunting out there.
Have a great day.